Well, all right. What's up, everybody, and welcome to the Middle Class Investor. I haven't been on here in a very long time. I think it's been close to 3.5 years. And really, I just haven't had much to say about the market. And I hope that's okay. I'm not, looking to monetize this or anything. I just post information from time to time when I think it's at a critical juncture, or if we have, a level of danger, what I consider to be danger in the market, and I feel like, I need to forward a link to some of my friends and family members. And of course, you don't have to abide by anything I say. There's predicting the market is very, very difficult. In fact, I've tried to do it many, many times and have failed, just full disclosure, and could possibly fail this time as well. But that's part of trading and investing in the market. So the market is difficult to predict, certainly on a day-to-day basis. But what you can look at and what you can identify is longer-term trends and potential moves against those longer-term trends. That said, what I have on the screen here is a very long-term trend that began way back in 1932, May of 1932, and it's continued all the way to January of 2022. So, long time, 90 years. And the reason I have this trend on the screen is because I think it's easier to explain what I'm about to tell you. So anytime you have a trend, whether it's a 10-minute trend, a 15-minute trend, an hour-long trend, a daily trend, a weekly trend, so on and so forth. Anytime you have a trend, and a trend is nothing but a series of higher highs and higher lows. And the key is, if you're looking at a trend, can you draw a line underneath it? And in here, you can see that I could draw, if I wanted to, I could draw a line underneath these lows, and that's an uptrend. Now, all trends, regardless of the duration, have periods of regress, okay? In other words, they retrace. That's where the idea comes from when you hear people talking about buy the dip. They're talking about, oh, this is a dip in an uptrend. So the question is, well, how do you know when the uptrend is over? Or how do you know potentially when a new trend is beginning? And this is a great question. This is a mystery to most people, and it's very difficult, even for people that know the market, people that are students of the market. It's still very difficult, okay? It never gets easy. And the reason is primarily because there's a probabilistic nature to the market, especially on a day-to-day, week-to-week basis. So that said, what is this trend telling us? Well, one of the things this trend is telling us is that it's likely over, okay? And we've got a year's worth of data, which I'll get to in a second, that demonstrates that this trend is likely over. So what does that mean for you if you've got a 401k or you have an IRA or you, I don't know, have whatever invested in the market? Well, that means that you could get a pullback or a dip that's proportional to the size of this trend that you're looking at on the screen here. And you're probably thinking, my God, Seth, that's 4.4 points at the low and 4,818 points at the high. I mean, that is a huge trend. So what are we talking about here? Well, your garden variety, kind of a pullback for this kind of trend would take you probably back to this low here around 2009. So, maybe you want to ask yourself, wow, am I okay with rolling my investments back to whatever they were in 2009? Do I have enough time horizon to sustain that? And the answer for most people is no. The reality is the market does always go up, Okay, you'll hear people say that, oh, the market goes up over time. That's right, but it depends on what time period you're looking at. And it also depends on what trend you're looking at. So even if I was looking at, say, this trend right here, okay, starting in, let's see, this trend started in 1974 and topped out at 2000. This is the .com bust right here. So from 1974 to 2000, that's a long time, 26 years, right? And then the market retraced. And I'm going to zoom in here for just a second because I want to show you where it retraced. It retraced below this pivot low right here, to just below that. So when I zoom back out, see, this is the pivot low for this move right here. So now I'm going to switch gears for just a second, and I want to explain why I think the market has topped and why you should be extremely careful if you have any money at risk in the market, and or if you're either at retirement age or near retirement age and don't have enough time to make money back. Okay? In other words, you need to be more conservative than less conservative. So first of all, the market moves in the direction of the trend in these 5 waves. So if you look at 1932 here, you see kind of a wave 1 up, you see a wave 2 back, a wave 3 all the way to here. 3s are always the longest and the strongest. Wave 4 here, and then wave 5. Now, if you examine this closely, what you'll see is there's a 1, 2, 3, 4, 5 here. Okay, so there's a 5 wave. I could draw this in if I had time and you had the patience to watch it. And then right here, there's a 1, 2, 3, 4, 5 right here, and then a regress. So there, you always get these 5 waves. Can you count 5 waves? And then you get some sort of regress. So let's talk about, we've kind of already talked about the big picture. Okay, so what I want you to keep in mind is that over the next several years, this is likely to be your target in this area right here. Now, it's not going to go straight down into this area. Okay, that's not the way the market moves. The market moves in big chunks, and then it rallies, and then it moves, and especially when it goes down, it moves very, very fast. There's a saying that people have. It says that market takes the stairs up and the elevator down. And if you look at some of the sell-offs that we've had in history, that is very true. If you look at this one in 1987, that's definitely an elevator down. And these are very dramatic and emotion filled and things like that. So you just don't have a lot of time to react to moves like that. So hence the video. And what I'm talking about should happen within the next, we're talking days or maybe a couple of weeks max. Okay, we're not talking about months from now. We're talking about this is upon us at the very moment that I'm speaking to you. And so what I'm going to do is I'm going to switch to a different time frame, and I want to show you that. I'm going to go to this weekly, 3-year weekly, and I'm going to sketch out for you the waves down off the all-time high. This is the S&P 500, by the way, that we're looking at. So if you look carefully here, you'll see, let me get zoomed in here so that everybody, I'm a little too close. Sorry about that. Let me, can't really zoom out more than that. Let me just try to make it work. So, yeah. Let me just go further out. I'll go to a 20-year, and then I'll just zoom in from here. How about that? That'll work. Sorry about that, y'all. I'm just a little rusty on the zoom tool. Just haven't used it a lot lately. So, as you know, I haven't made any videos in a long time. So we had this move down, then we had this move here, countertrend. And then we had this move right here, back in the direction of trend. And then we had a rally up, counter trend. And then we had this move into the low here. Okay, notice 1, 2, 3, 4, 5. Now this 5-wave thing, this is just a way to determine that there might be a change in trend. Okay, might. I want to stress might. But given the duration, this took almost a whole year to go down. And certainly this whole thing here has taken about a year. So given the length of time it took to make this move, and the fact that it's 5 waves, and the fact that this move here is very counter-trend looking. So what do I mean by counter-trend? Well, what I mean is it's very overlapping. See how it kind of overlaps quite a bit right in through here? So that's pretty indicative of a counter-trend move. So you can see there's a move up, there's a move down, and then there's a move to this high, which retraced quite a bit of the move down. And this is not uncommon in the first move off the high. But you're not going to get retracements like this after this starts moving down rapidly. I just want to warn you about that. So here's the rule. If you have an important high, which this is, this right here, I'm calling this an important high right here. The reason it's an important high, well, there's a couple reasons. One, it's an all-time high. But another example of an important high would be right here, because there's a pivot. Anytime you have a pivot, so this, when I talk about pivots, this is a pivot right here. Okay. And so anytime you have a pivot, you can kind of put a zone above the pivot, and the market will, next time it moves up, it'll move into that zone before it sells off. So that's what that pivot means. So this right here is an important high. This is an important high. So this important high is very similar to this one. See how the counter trend went up to a lower high and then sold off. So that's what we're looking at here. Now, what you can expect out of this move next is something pretty dramatic. And of course, the question is how dramatic. Well, the first move, it'll probably stop in this area and then retrace a little bit and then come down here like this. But I want to show you what I kind of see. This, if you break this down into the previous trend, and I don't have the whole trend here on the screen, but this is 2 right here. This is 3. All of this is 4. So A, B, C, down here to 4, and this is 5. So what happens is when you have a change in trend, you end up retesting what we call the 4th wave low, which is in this area. So what I'm expecting the market to do on the S&P 500 is to come down into this 2000 area before you get any kind of real stop that you could have a chance of repositioning yourself, okay? So we're talking about really not stopping a lot from here down to here. So, you can do with that information what you want to do, right? It's your money. You get to decide. But I can just tell you that once this starts going down rapidly, it's very, very difficult to take action because you get stuck in kind of a psychology loop, right? The market goes down 20% and you go, gosh, man, I should have listened to Seth. I should have sold. I'm going to sell. If I get a bounce here, I'm going to sell into the bounce. And maybe the 20% move, half of it gets retraced in what we call 50% retrace, and you don't sell. Okay, this is very common. Market rolls over and goes down 30%. So now you're down like net 25 or something. And you tell yourself, well, I should have sold. I'm going to sell next time if I get another bounce. Well, the problem is the bounces get smaller because more and more people are thinking like you. The second thing that happens is you just don't do it. People don't do it. They start rationalizing things like, well, I'm probably closer to the bottom, so I'm just going to stay in. They start talking, the self-talk kicks in, the psychology of it, and you just don't take action. So you end up riding this thing down all the way down into here. you know, and that's just, that's very difficult to recover from if you're trying to retire or you're retired or so on and so forth. So just a little side note there. All right, now I'm going to switch. I'm going to switch to a shorter term. I'm going to switch to the shorter term weekly, and I'm going to zoom in. I'm going to zoom in on this area right here. So I just want to point it out to you. This area, I'm going to zoom in on this area right in here. Because what I want to do is I want to show you that there's 5 waves here, and then this is counter trend. In fact, the counter trend move is over, and we've got another wave, 5 waves down with a counter trend that's not finished. And I want to point that out. And what I'm saying, what I'm doing, is I'm getting out of the way. So to me, a bear market is it's like a train rolling down the tracks, just full speed ahead with thousands, hundreds of thousands of tons of cargo. And if you stay on that track, you're going to get run smooth over. Okay. So my philosophy in a bear market is just step off the tracks, let the thing go by, let the train just roar down the track. It'll be gone soon enough. And then you can get back on the track. But you want to stay out of these bear markets because, especially the big one, like a 1932 to 2022 kind of bear market, that's one you definitely want to try to avoid. All right, so let's look at. I'm gonna switch to a daily. Actually, I'm gonna switch to a 4-hour chart. Well, maybe I'll switch to a 1 hour because I want to be able to show you. Yeah, so let's look at this. I'll kind of zoom in on this area right here. And same thing, we got an initial move down. We've got a counter trend move, up. I didn't get the arrow in there. Then you've got this third wave down, and then a fourth wave up, and then your fifth wave down. So you've got 5 waves in the direction of a potential trend change. Well, how do we know it's a trend change? Well, you got to go look at the counter trend move, or what could be the counter trend move, and notice that there's quite a bit of overlap. So we've got a move here, and then down here, and then, whoops, I did it wrong. Up here, right? And then you've got this move here, which is kind of a consolidation move. It's pretty typical. So what I've got here is I've got what's called an A, B, C. And the reason we know this is C is because it's 5 waves. The C wave in an ABC is always 5 waves. Now, if I zoomed in further, what I would be able to show you is there's another 5 waves right here. 1, 2, 3, 4, 5. Well, this is part of 3, and then it can extend like it just did there. And so that means that now we've got a 5-wave move, a counter trend, another 5-wave move. This market is likely going lower. And so the question is, we're going to be looking for some sort of move against this move here. So what I'm doing personally is I'm looking. This has already gone up. This has already gone down. I don't think it'll make a new low in the morning. Hopefully it doesn't, because you want a chance to get in if you want to be short. But I'm looking for a move into this area. This little candle right here is really critical. So let me zoom out and let me show you where that candle is, where it is on the chart. It's right here at, let me just make a drawing here. This price level right here. So it's right here at the top of that candle, which is 44, let's call it 44.45. So 44.45, in my opinion, at this very juncture on September 18th, 2023, I would not want to be long the market if it gives me a chance to get out up here in this area. Let's just call it 44.70 to 44.80. If this market lets me out tomorrow at 44.70, 44.80, I'm out and I'm sitting on the side of the tracks and I'm going to watch that thing just roll on down and just steamroll all the people that are in the market. That's my strategy. And, again, the reason I started with that ultra long-term trend is to try to show you how far back this trend goes. And it's part of the psychology. One of the reasons there's a lot of bullishness in the market right now is because people become increasingly bullish at the end of trends. This is just part of the psychology. At the end of uptrends, let's say. And they become more and more bearish at the bottom of bear trends, downtrends. So this is just kind of the nature of the market. The market has a tendency to get everybody on one side of the boat. And then, of course, if that happens, the boat flips over, right? So what you want to do is before the boat flips over, you want to kind of step to you want to just kind of get out of the boat, right? Just gently get out before anybody starts panicking and pulling hair and kicking and biting and all this craziness that goes on during these panic modes. So I think that's about all I have to say. Feel free to leave comments in the comments section. It's your money. You do what you want. I just, a lot of people ask me in the last bear market, well, Seth, how did you miss it? Because I just stepped off the track and I let it go by. I'm talking about 2008, 2009. And I said, well, I tried to explain to them, and stuff. And, a lot of this is, most people aren't very interested in this, and that's fine. But there is a method to the madness. There is a reason why certain people can, quote unquote, predict. And I'm using the air fingers quotes, because prediction is very difficult. It's not really prediction. We're just looking at evidence on the chart. What all these bars mean, this is just people, the bigger the bars, and I don't have volume up, but you can look at volume too. This is just, it tells you like who's selling. This isn't Aunt Mary and Uncle Bob selling. This is big money, people that have billions and billions of dollars at risk, and they're distributing stock, meaning they're selling because they don't see value or they see trouble. It doesn't matter what they see. The point is, on the chart, it's telling you that the big money guys are selling. And so that's how this is essentially done. I'll show you on a daily chart. Anytime you have these big bars, these are days where big money is selling. And so and these bars are going to get really big here pretty soon. So just know that that's how you do it. And it takes a lot of study. It takes a lot of practice. It takes some losses. You got to get comfortable with losing money. There's a whole there's a whole education that is served up to you in this area. So I'm going to be sending this out. I hope you don't mind that you get an email from me or a text or something with this video. And like I said, go in and leave a comment. Tell me I'm crazy. Tell me I'm wrong. Tell me you like what I said, but you don't believe it. Whatever. Doesn't matter. I'm just putting it out there into the ether, and whoever wants to look at it can look at it. If you don't want to look at it, that's fine too. All right. Thanks for coming in. Appreciate you listening. Peace.